Going to talk about money. What are we going to talk about? How many of you understand the power of education? All right. And, a lot of people, mindset is one thing, but you need, that's kind of like your left hand. But your right hand, not only do you need the right mindset, but you need strategies and tools and ideas. And I'm a big believer in many of the people that I bring up here on stage to give you some great content, some great insight. And then if you want to further your education, you know what? Just be the bigger person. Everybody say, be the bigger person. How many of you here are interested in learning, please? Because let me tell you, one of the biggest stresses on your relationships has to do with money, correct? And people say, oh, money's not that important to me. Or, oftentimes you hear someone say, oh, all we need is love. Well, that's what the Beatles said, and they broke up. And then, of course, you got Sonny and Cher, I got you, babe, we ain't got money to pay the rent. Well, they divorced too. But so you got to have cash. You with me? And what I want to do over the next 3 days is give you some ideas, concepts. Look, some of these people you may have heard before, some of them you may not have. That's okay. Just work with us. Come on, you with me? And they're really going to help you. But the gentleman I'm about to introduce to you, I met him quite a few years ago, and he was I think basically in high school, or just out of high school. Is that correct? Pretty close, yeah, pretty close. And I went in to speak for his dad, Len Goodwin, right down the back there. So Len, would you please stand up and give Len a big hand clap, please, if you would. And we came in, and I met Daniel, and he'll tell you I was able to have a small part of his life in mentoring him and helping him. And he runs an amazing business called Prowealth, national business, really helping people. Now he's here to give you 30 minutes of incredible content. Are you ready? Are you ready to learn? All right, ladies and gentlemen, please stand up and welcome to the stage my great friend Daniel Goodwin.
Thank you, Pat.
Awesome, brother. God bless you.
He's very modest, Pat, isn't he? He's certainly not one to trumpet his own horn, but Pat was certainly the inspiration in the early days. I went to a seminar with Pat down in Sydney and a couple of other guest speakers, and they talked about writing a book. And it so happens that this book is the result of that seminar. So just again, a round of applause for Pat and all the fantastic work he does in mentoring people. So what I want to cover today is I've got a short time frame, 30 minutes, to talk to you about how to buy a property with your super fund. Now, can I get a show of hands? Who owns a property currently, a home or an investment property? Yep. Okay, who has some super? Every one of you put your hands up. Every single one of you have super. Who has a self-managed super fund already? Anybody? Oh, okay, excellent. Who owns a property in their self-managed super fund already? Excellent. All right, so what I want to cover today is really content. So I'm going to skip all the parts about our company and the history and that sort of stuff and really get straight into it. Suffice it to say, we've got 5 arms of our business that look after all those particular needs. Now, as we're going to be talking about super and financial products, I haven't whipped around the room and found out all your personal information. So what I want you to understand is that today is just general information, and you'll have the opportunity to come and see us at the end and ask lots of questions. We've got 2 offices down in New South Wales and 2 offices here in Brisbane. And of course, you can come and see us on the web. And if you want to make an appointment with us down the track, we can certainly do it via Skype and FaceTime if you're not close to one of those offices. So who argues about money? We went through this morning. Everyone, put your hand up. You've all argued about money at some point, I'm sure. Well, what I want to show you today is that if you decide to set up your own self-managed super fund and buy a property with it, as opposed to shares or in addition to shares, anything like that, we've got a few things that we can do. And we're going to do a live demonstration of this today on the screen so you can see it's real. So the first thing we can do is we can eliminate the income tax you're paying in your super fund. Does anyone know how much tax you pay in your super currently? 15%. It's capped at 15%. So we can get that down to 0. The second thing we can do by buying through super is get our capital gains tax down to 0 later, because there's some wonderful tax advantages inside super. Many of you will know of those. I'm going to cover those very briefly today. When you buy a property with super, you have the unique opportunity to have 2 forms of income to help pay it off. You have the rent, and what else do you have? Your employer contributions. Every single one of your employers has to pay 9% of your super into a super fund of your choice. And over the next few years, under the Gillard government, it's going to go up to 12%, isn't it? So that's going to increase and increase and increase over time. So I want to show you that by buying a property in a self-managed fund, they're all positive cash flow. All right? They have to be for the loan to work. So there's no such thing as negatively geared property in a super fund. You own it outright fast. Because we have those 2 forms of income, we have the ability to divert that income into the loan and pay off the property extremely quickly. So in terms of arguing about money, you never have to do that when you buy through your super fund because there's so much cash available there. We're going to show you all of that today. So a super fund, if you look at it sort of on this level, like a normal property, you'll have a value, you'll have some equity, and you'll have some debt. Now, the first thing you need to understand when you buy through super is you'll need a 20 to 30% deposit. All right, so if it was a $300,000 property, you're going to need between $60,000 and $90,000. Now, if you don't have that in super, don't worry. It just means you might have to find a cheaper property. Or perhaps we have to put a process in place to salary sacrifice some money to get you up to the level that you need to get to the property that you want. In super, you can also have 4 members. So typically it's husband and wife, but you can also bring in older teenage children and things like that as well. So I don't want you to switch off because you think, oh, I don't have enough super, I won't be able to do this. All right, we can put a process in place. And as I said, what we want to do is we want to divert the rental income and our 9% contributions into the loan for this property and pay it off extremely quickly. That's the goal of buying through super. Now, the tax advantages, some of you are aware of the tax, but if you were to buy an investment property in your own name, so there's lots of ways you can buy property or buy any investment. We've got the most common 4 on the board, by no means are they only ones, but if we look at joint tenants or tenants in common, so that's when you buy combined with your spouse, or perhaps you buy 99% one person's name, 1% in another. You can buy through a trust. You can buy through a company. They're all taxed at different rates. So even after capital gains tax discounts and things like that, you could still pay tax between 15 and 45 cents in the dollar. Now, if we contrast that with a super fund's tax rates are extremely attractive because before retirement, so before age 60 and while you're working, the income is capped at a maximum of 15% income tax. Your capital gains tax is capped at a max of 10%. So if you bought a property in your super fund today, it was $300,000, you sold it after you were 60 and you retired, and let's say that property was worth $600,000 in 20 years' time and you sold it, you can get to a point after 60 and retired where you get from 10% maximum capital gain down to 0 and pay no tax whatsoever. Right, now again, contrast that with your own name. If you made $300,000 profit on a property in your own name or your trust or your company, you're going to be giving away 30 to 40 cents in the dollar. So super is an extremely powerful way to build wealth and not pay Wayne Swan and everybody else at the government along the way. We'd all like to keep some more of our money, wouldn't we? Absolutely. All right, so where does it fit in? So we see a lot of clients and we help clients buy investment properties in their own name. Right, we're talking about super today, but we help a lot of people in their own name. And the main reason clients come to see us is they say, well, we've got a home loan, we've got some debt, we want to get that home loan paid off as quickly as we can. And one of the strategies is, of course, looking at investment property, getting some of the tax advantages, reducing tax in buying investments. What I want to introduce to you is, with buying a property in super, it's not an either-or choice, right? If you have the ability to buy in super, I don't want you to say to me, Daniel, should I buy in super or should I buy in my own name? You should do both, because neither one affects the other. I'm going to show you more of that today. So this is how we're structuring a lot of clients' portfolios now, is I know there's a few of our clients in the room, we have investment properties in your own name and we add one in super that we're going to keep for the longer term until we retire. That's the strategy. We're going to direct, while in our working lives, all of our 9% contributions, that's between ourselves and our spouse, and all the rent to reduce that loan as quickly as we possibly can. And certainly the strategy we try and put in place is to make sure it's paid off by the time you want to retire and you're past 60. And then, as I said before, with the tax advantages, we can sell that property, we can pay no capital gains tax whatsoever, we can take that cash out of the fund and move it across, and perhaps if we've got some debt on our home loan, reduce it, some debt on our other investment properties, reduce it, if we've got some credit card debt, whatever it is, that cash is there at your disposal. Then from there, you can look at a lot of those other strategies. So I'm sure you've seen lots of property companies over the years and they've talked about, never selling your investment properties. Why do they say that? Why do they say never sell? Because of the capital gains tax problem. Right? So in super, you can sell because you don't have a capital gain tax problem. And what you can do is move it over here to your other investments in your own name, where now you have the ability that if you wanted to, you could draw the equity out of those and pay no tax. You could, of course, sell it and pay the tax if you wanted to, or just take the rental income. So that's the concept I want you to get your heads around today, is that super is very different to buying in your own name because it's a unique ability to take the money out tax-free and use the tax advantages for your retirement. Now, everyone has super. We talked about that a moment ago. So who's been absolutely excited with their performance of their super fund over the past 5 years? Everyone? All right, so what we've got on the board here, I want to show you, is that I'm showing for the past 5 years the average return of diversified super funds. Now, if you don't know what that means, it's, there's Hester, Ozcol, AMP, MLC, there's hundreds of super funds. What this shows you is the average return for the investment option. So at the bottom of the screen, you'll see there's conservative, balanced growth, high growth. Now, when you start your job, your employer will start putting your money into a super fund for you. Typically, if you don't tell them to do anything else, your super fund to do anything else, they'll invest your money into the balanced or default option of the super fund. Right? So that's the second one on the screen. So what I want to get from you now, I'm going to show you the result there. The average conservative fund over the past 5 years, the average return has been about 3%. Does anyone want to have a guess at what the average balanced funds returned over the past 5 years? -1, -2, all negative people. But a balanced fund, about 1.7%. All right, so again, not sort of shooting the lights out. What about growth funds? 0.3. There's a bit of a trend happening on this graph. What about high growth or all growth? Where are the negative ones? Yep. So the average high growth fund or the all growth fund, if you're unlucky enough to decide, I want all my money in the highest growth option of my fund, on average, you've lost about 2%. So super certainly hasn't been performing the way it was perhaps 10 years ago. So let's look at some specifics now. So I'm going to put 6 super funds on the board. So we've got First State Super, Hester Super, Australian Super, Auscol, Rest and Q Super. Put your hand up if you're represented by one of those super funds on the board. Okay, probably about half the room. So let's look at the actual return, the average return for the past 5 years on these funds. Now this is data from a week ago, right? So it's the most current data that is available. So in First State, if you're in the default option, these are all the default options, you've had an average return of about 1.9%. If you're in First State, or Hester, sorry, you've got to have 1.4, Australian Super, around 3, Auscol, we're up around 2, Rest, which is your retail, 2.4, and Q Super, which is a lot of your government type jobs, 2%. Now the problem I have with this is that most people don't pay a lot of attention to their super. So put your hand up if when you get your super statement, you look at it and go, oh, I'm a long way from retirement, I'll stick it in the drawer, I'll worry about it later. Yep, so again, depending on your age, it's more important to you, isn't it? So what I want you to think about is that if you pulled your Australian super statement out and it said you had an average return of 3%, how do you know whether that's a good return or a bad return? CPI is one, but for most people, you've got no basis for comparison, do you? Because not a lot of you are going to be researching different funds every day of the week. Who's ever changed super funds? Not from their employer changing it because you moved jobs. Who's actually went and changed a fund themselves? Okay, it's a few people. Very few people do it because they don't have that basis for comparison to work out where they should invest. So it's very difficult to understand what you do. One of the things I want you to do when you leave this conference on Monday or Tuesday next week is look at your super statements. And I've put a few on the board. Every super statement that you receive has the returns on it. So I've got First States up there, Russell Investments, Local Government Super. They've all got them. Have a look at what your returns are. Because I would challenge most of you, you're probably not going to be seeing a greater than a 5% return over the last 5 years. In fact, a lot of them are going to be negative. Right? So it's important that you think about that. The big picture is this, is that if you're getting average returns around 3 to 4% in super, with the 9% going in, and you're 45 years old today, and we've got the combined salary, so let's say a husband and wife earning 130 grand combined and 150 grand in super today, at age 65, if you were getting a 4% return, you're going to have 300,000 at retirement. Right? So in that case there, it's about $500 a week to live off. You might think, well, that's a lot. Well, I hope you don't think that's a lot. I hope you think that's pitiful. You want a lot more money than that. But that's the reality. And if you live for 20 years, from 65 to 85, that's the only income you have. Now, who wants to live past 85? Well, more people, you're not going to drop dead at 85. You don't want to live a lot longer, so that's not going to be enough. The other big problem that we see is a lot of people haven't put anything in place to pay off their home loan. So if you're in your 40s today or 50s and you've recently bought a home, you've probably taken out a 25 or 30-year loan. So unless you've put something in place to get rid of that loan, come retirement at age 60 or age 65, you may still owe $200,000, $300,000, $400,000, $500,000 on your home. How are you going to get rid of that? If your super is going to be used to pay off your home loan, what are you then going to live off to retire? So I think it's important you think of the big picture with super is that for a lot of us where we're not looking at it every day, you've got to start thinking about it, and it is your money. Right? It's your money, just not yet. So it's really important that you actually keep track of it and where it's going. So if we look at sort of Super 101, we throw up an economics, first-year economics students graph, and we say, well, if we're going to invest in our super, we want to look at whether it's easy to understand or very difficult, and we want to look at the level of control. Is it easy to control or very hard to control? And I'm going to put your current super fund about here on the graph. It says current super fund if you can't read that. So low level of control, I think, because in your super fund, do you really have any influence about how it gets its returns over time? You don't. You can't call your super fund and say, I want you to buy BHP shares. I want you to buy Qantas shares because I heard they were cheap this week. Your super fund won't do that, do they? They diversify it. What about, is it easy to understand? Well, I just showed you 6 super funds, and let me tell you, I didn't actually show you the worst, and I didn't show you the best, I showed you a cross-section. There was a lot of funds that were a lot worse than that, but not many that were better. So it's very hard to understand if you're trying to pick a super fund, which one do you pick? So that's where I place that. Let's look at shares. I know we're going to have other people talk about shares and things, but if we talk about trading shares inside a self-managed fund, if you're not a share person, what level of understanding do you have about shares? Do you know how to value a company? Do you know what to look for in a share? Do you know what price to earning ratios and things like that are? So if you're not following it, again, very hard to understand how to invest in shares safely. What about the level of control? What level of control do you have over the stock price of a certain share? At your level, probably, very minimal. If you've got millions and millions of worth of shares, you probably have a bit more control. What else have we got here? We've got choosing a super fund. Well, I just showed you that one there. Again, very difficult to understand why some perform better than others. Choosing an investment option. So you might think, well, I want to go into the all growth or the high growth option in my fund because I'm happy to accept a little bit higher risk, but I'm hoping for a higher return. Now, that's what you would expect, but at the moment, it's the exact opposite. If you enter the most conservative super fund, you've got a better return than had you had your money in the growth option. And the reason for that is all the big super funds are moving their money out of risky investments over to cash and into bonds, because that's what the market's doing, is they're protecting your money for you. So again, I think that's very hard for most people to understand, and again, very little control. Let's look at bonds and currency. The US dollar changed 5 cents in the course of the last 2 weeks. So what influence do you have over the exchange rate? Do you understand what happens if something happens in Greece or Spain or America, how that impacts our currency? Right, so again, hard to understand. All I'm talking about is investing in super through one of these particular asset classes. So what we wanted to do for people was say, we need to think of a way better way to do this. We want to do something that's really, really easy to control, and we want to do something that everybody can understand. And we think buying a property in a super fund is the best way to do that. A self-managed fund is all about control. Control is the most important aspect of any investment you'll ever buy. So in a self-managed fund, you make all the decisions. Now, is it easy to understand? Who own property? Quick, hands up. Everyone in the room has already owned a property or is probably going to own one. You all know how property works. In a super fund, it's exactly the same, except the deposit is coming from your super fund. And there's a different name on the contract. Right? So we think that's very easy for most of us to understand. So if we consider all of that, what I want to show you is those super funds there, those 6 super funds, their average return over the past 5 years, and let's contrast that now with a different asset class. Let's look at property. So I'm going to show you 6 different property suburbs. Now the suburbs I'm going to show you are areas where Prowealth, we've been around since '94, so we've been selling in these areas for about 16, 17 years. I'm going to show you the average return of some of these suburbs where we've been selling. This is the past 5 years. So we've got Maitland, down Newcastle, Aberglasslyn, Mossabrook, Cameron Park. This is down in the Hunter Valley of New South Wales. And I've got 2 local, or semi-local, Brisbane ones, Chermside and Kelvin Grove. Now, if you look at those returns, every single one of those median price performance is higher than the average return of all the super funds. Right? Now, on top of that, with property, you also get a rental return, don't you? So if you look at total return, you're into the early teens on a lot of the properties. Now, this isn't by any means the best places to invest in Australia. There's hundreds of great places to invest. But most properties follow this same profile. They have some good capital growth if you buy in the right areas and some good rental return. Now, the skeptics usually say to me, well, look, super's a long-term investment, Daniel. What about over 10 years? Right, so let's look at those same super funds, those same 6 funds, and look at it over 10 years, and you'll see that it evens out. It's around 5 to 6% average return across those particular super funds over that 10-year period. Well, let's look at property to be fair, and let's look at property over those same 10 years. So the median change in capital growth over that time, you can see anywhere from 6 up into the teens, and again, what else do we have? The rental returns. So you're getting your returns way into the teens. So there's simply no comparison between leaving your money in its existing super fund and borrowing and buying a property where you're going to have the capital growth and the leverage and the rental return. Is everyone following? So how does it work? There's 5 key elements for you to buy a property in your super fund. Right? So the first part is we have a look at your current super, and we sit down with our planner and we work out, can you move the money into the fund? About 95% of the population has the ability to move their money from their current super fund over to a self-managed fund. So once that's been established, simply some paperwork, and we transfer whatever money you had in, say, Hester or Australian Super, or even a portion of it, over into the new bank account for the self-managed fund. This is what you control. From there, we talk to your employer. And again, about 95% of the population has something called choice of super. Even if you don't, it doesn't stop you. You can move your 9% employer contributions into the super fund's bank account. So your employer, instead of paying into Hester every week, is going to pay over into your new super fund's account. From there, it's a matter of identifying the property we want to buy. So we found this investment property up in the corner for $300,000. And in this example, we're going to use a 30% deposit. So that's about $90,000. So we're going to take $90,000 from our fund. We're going to stop by the bank, ask the bank manager to loan us the rest, and that'll be $210,000, so $300,000 total. We're going to go over and we're going to give that money to the property vendor, right? Forgetting about stamp duty and all that sort of stuff at the moment. From there, what are you going to do? You're going to put a tenant into the property, so you're going to pick a property manager. It's your super fund, you pick the property manager. The tenant's going to pay rent. Now, where do they pay the rent to? To you or to the super fund? That's right. So the tenants then commence paying the rent through your property manager, and that rent goes in every week or fortnight into the super fund's bank account. Now, from there, your employer keeps paying in every week or every quarter, and the bank starts taking repayments like a normal home loan out of the super fund's bank account. Right? But a normal investment property, we don't have those 9% contributions going in. We only have the rent. Right? So that's what makes super very, very powerful. So if you can understand that concept, that's the first part to getting around buying a property in super. So looking at that, what I'd like to do now is do a live demo of exactly what we do in the office if you come in and see us. So I'm going to bring up an Excel spreadsheet in a minute and we're going to punch some numbers in. Now, the key with a demo, and the reason I like to do them, is that in a lot of seminars, people put up numbers and things, and they're not always the real things, are they? So I want to show you something that's a real property. We're not selling anything today, but I want to show you, if you decided to do it, what you could do. The demo example we're going to use is a house and land package in a Mirvac or a Stockland estate. That's predominantly the people we build with. You can buy units, townhouses, you can buy lots of stuff, but for the example, we're going to use a house. If you do choose to buy through us, obviously all the houses come turnkey and ready. We've taken the feeling that with our investments, we want to keep them specced out to the highest degree, so the best inclusions, which you'll sort of see all the way through there. So let's get into that demonstration so you can see how that works. What we want to do is have a look at, with our super, how we can fund this property and not have it cost us any money. So you'll see on the right-hand side, I've put in that same couple. We've got a couple on a combined income of $130,000, and we're going to say they've got $150,000 super between them right now. We're going to buy a house and land package for $424,000. We're going to need a 30% deposit, which is about $127,000. Now again, don't think if you don't have this much money that you can't do this. We just got to get to a cheaper property. Now, stamp duty, the first cost you're going to pay is stamp duty, like with any property. There is an incentive right now from the New South Wales government where if you sign a contract before June 30, you'll pay no stamp duty. That gives us about 2 weeks to do it. It is doable, but if you don't, you would pay the whole lot. So we're going to say that we do save the stamp duty in this example, and different states from time to time have different specials. When you buy a property, you're going to have some legal fees, you're going to have some bank application fees for this type of loan. If you don't have a super fund already, to set up the legal framework and all the paperwork that goes around that is going to be about $4,500. So all up, you're going to need $135,000 worth of super. Remember, our couple has $150. All right, so from here we put in all the variables. So we've got our rent $460, we've got our interest rate, we've got the council rates, we've got all that sort of stuff. The only other unique thing that we wouldn't have on a normal property is the cost of running the super fund itself. So each year it's going to have to do a tax return, some audits, pay some government fees, and that's going to be about $3,500. We also can claim depreciation, right, on the house inside the super fund. Again, it's no different to a normal investment property. We still claim all of that. So let's go back up here and see what impact that has had. So you can see here, we had $150, we needed $135. That gave us $14,000 left over of super. One of the things you can do, with depending on the lender, is put that spare super money into an offset account. Who's got an offset account on their home loan? What does it do? It saves you interest on the equivalent amount of money that you have. So that $14,000, we could say, let's put that into offset there to start saving some of that interest. Because remember, that's going to be saving us 6.99% interest. Where else would you get a return of 6.99% and have it totally safe sitting in a bank account? Right? Very hard to find. From there, we can look at other options. We can say here, look, here's our employer contributions. 9% of 130 is the 11.7. We're not going to salary sacrifice in this example. Net rental, 23,000. That's after a vacancy rate. So we've got 34,000 a year coming into our super fund. From there, we have to pay all the expenses for the property out of our fund, not out of your pocket, out of your fund. And that also goes for all these setup costs over here. That's all paid for from your fund, not from your property, not from your own pocket. So the first one is about $19,000 of loan interest. Then we've got our property running costs and super fund running costs. So remember that 8.2 that you see on the screen is that figure there coming across. All right, so about $27,000 a year in costs. So you can already see we've got more money coming in than going out. Everyone see that? On top of that, we can also claim the tax deduction. So we're going to claim about $12,000 in depreciation, which is the combination of your building and fittings. We're going to claim back some tax on the setup costs of about $440 a year, and that gives us a non-cash deduction of $13,000. Now, this concept that I'm explaining, I am going very quickly to stay on time, is something that's normally explained over about an hour and a half. So if you're not following, come and see me at the end, but we're going to keep it moving pretty quick. This is one of the important parts, is that the tax office says your fund has earned $34,000. It paid out $27,000 in expenses, and it also had a deduction of $13,000. So for tax purposes, your fund didn't make any money, and on paper it shows a loss of $6,000. What that means is immediately your tax rate has gone from 15% to 0, right? Because in your current fund you have no deductions, right? Other than maybe insurance premiums. That's why you're paying 15%. Here we're claiming all the deductions against the property. Now, what's more important to you is the actual cash position of the fund. And the cash position is simply what money came in, 34, what did we physically pay out, 27,000. So our cash position after some fees is about 6,500 a year. If you divide that into a weekly figure, it's $126 a week cash flow positive. So you could buy this property, have 14,000 worth of super left over, and it not cost you a cent. In fact, every year it's going to generate excess cash of about $6,000. Does that make sense? But remember I said the goal is to pay this loan off extremely quickly. So what we're going to do now is we're going to move this over here, and we're going to use a simple home loan repayment calculator. A lot of you would have done this with a broker when you got your home loan. What it does, it works out how quickly we can pay off a loan. We've got our loan amount in here after the offset account. We've got our interest rate over 30 years. So these loans start over 30 years. What we're going to do is we're going to say, well, this 5,000 we've got here, we're going to use that each year and pay it off the loan. So every July you come and do your tax return, we'll ask you what excess cash do you have, and we'll say let's put it onto the loan. So let's put an extra repayment every 12 months of $6,500. And watch that 30 years. That 30 years has dropped to 16 years. So if you were 43 years old today, based purely on those numbers alone, by the time you hit 60, you could retire, convert your super fund into pension phase, and take all that money tax-free. So that means the property is owned outright. Okay, so my question to you is, if you've got 135,000 in super today, because that's what we just used, what do you think that would be worth in 16 years' time? 230, 330, 400? Whereas in this example, because what I always say to people is think, could you be worse off? In this example, you bought a property for 420. Over 16 years, if it didn't go up a cent in value, which we all know it probably would, but let's say it didn't go up a cent, you own it outright at age 60. So you could sell it and take all that money tax-free, so about 420,000. So it's hard to see the 135,000 that you had in super being worth more than 420,000 over 16 years. Does everyone sort of understand that concept? Right, so I think that's very important. Now, there's lots of other ways we can modify that and increase it through salary sacrifice and things like that, and we just don't have time to do that today, but we should certainly have a look at that for you in the future. So, oops, jump down here. So let's just go back to this, a few minutes to go. The top 10 reasons I think you should consider buying a property with your self-managed fund. Number one, physical asset you can see. You can buy 2 Smith Street around the corner here. You can drive past it every Saturday if you want to. You want to know how much it's worth? Pick up the local paper and look at the real estate section. Very, very simple, as opposed to your shares, which a lot of you, who knows the balance of their super to the nearest $5,000? Very few, all right? I would say that's less than half the room. And again, because there's probably a bit of that care factor of whether you care about that or not. You don't need the full purchase price. I think we've covered that, 20 to 30% deposit. You've seen the tax benefits. You've got absolute control. You know, you decide what property to buy, what property manager to hire, all that sort of stuff. Your boss is paying for it. They're paying those 9% contributions. Over the next few years, it goes to 12% under the government. Okay, so your boss is going to continually help you pay for this property. You can combine your super balances. You can have up to 4 members. So yourself and a spouse is typical. But if you didn't have enough money by yourself, by combining your spouse's money, maybe you could and buy a better property or something like that for you. You can offset the loan with excess super, and you can pay it off extremely quickly, as you just saw in that example. I know we did one when we were running through this presentation earlier, that if it was a couple and you salary sacrifice $50 each per week, and that's not a lot of money, and you put it into that super fund, you would have that loan paid out in 10 years. Right? So that's how powerful it can be when we combine this with a lot of strategies. So I'm saying there, it's very hard to see how buying a property in a super fund could be any worse than what you would have had in super anyway. Right? So that's something to consider. It's positive cash flow. So in terms of arguments about money, there's never a need. Okay? If you want to talk to us outside, I'll show you that if we took away one of those couples' incomes, we would still have a cash flow positive investment in the fund. So we actually don't need both incomes to do it. So we've got lots of different options. The final part, as we sort of wrap up, is that we do everything for you. So we're a full financial services company. I know that's hard to read, but we have a property investment arm. We have a finance arm which looks after the loans and things like that for you. Accounting, so we can set up all your structures, your super fund, that sort of stuff. Financial planning is looking at your existing super and insurances. And of course, property manager to manage the property for you. If you have your own advisor already, that's fine, you can use them. But we do have the services available if you want to do it. So in closing, Pat was gracious enough to have me up on stage today, and he asked me to put some sort of special offer together on the phone. So the first part was, I want to give everyone a free copy of the book. Awesome. So everyone's handing you out some information sheets. Are they all coming out, info sheets? Yep. Fill in that info sheet, give it to one of the guys out the door, and they'll give you the pack. We've got about 70 books here, and there's more than that in people. Hand your form in. If you don't have a book in your bag, we will mail it to you Monday, Tuesday next week. But get in there as soon as you can and hand that in. The final part is we spoke to a couple of our developer partners. So if you buy a home from McDonald Jones or Ausbuild in Queensland, they're going to throw in the upgraded inclusions free. If you want to do an investment property, as we said, you've got a free choice of facade. They'll also do steel frame in lieu of a timber frame. So these are things you would put in your own occupied home. And of course, Mirvac and Stockland down in New South Wales, they've put a hold on some lots for us because I know a lot of people want to act before June 30 and save up to 22 grand in stamp duty. So I'll leave you with that information to fill out that sheet at your leisure, and in the next break, hand that in. I think Pat's coming back up. And I'll leave you with the final thought from the legendary Jim Rohn. Everyone knows Jim Rohn?
Yep.
Should do. And I think that speaks for itself. So thank you very much, Pat. And hopefully we'll see you all outside soon. We'll be there to answer your questions.
Give Daniel a big hand, guys.